the COMEX margin requirements, I think, do make a lot of sense if they increase them in this environment. And I would expect them to continue to increase them. And yes, it does actually affect things because it's not just the longs, if you like, but it's also the shorts. So you find that the shorts get squeezed in this environment. I mean, the silver market is one where there is actually very, very low participation by speculators. Just look at the open interest. It's around about 150,000 contracts. I would say that the normal level is probably around about 170,000 contracts as an average over time, maybe a little lower than that. But this is not, a market which is driven by speculation at all. So when the margin requirements are increased, it doesn't hit the speculators so much, it hits the establishment. So, it hurts the bullion bank traders, the swaps, that category in particular. I think it's an interesting point that it's a further discouragement to miners hedging. I can understand that. I think as far as industry is concerned, they don't care too much about this because they're in there buying silver, basically, by stand for delivery. That's really their interest. But it's all part of this tightening up the market. I mean, there was someone who put out a thing the other day about how the increase in margin requirements on COMEX was hitting the big US banks. And consequently, the Fed had to step in with repos of around about 17 trillion. Sorry, 17 billion, not trillion, 17 billion. Now, actually, if you looked at the numbers, I mean, there's complete nonsense because it's not the banks who are short. They're actually long of silver derivatives. It's the non-US banks, the 17 non-US banks, which are short. And of course, they're long in London. The Fed, this was on Christmas Eve, the Fed producing, repo, intervening in the repo market. I mean, the reason they intervene in the repo market is basically to hold the rates within their target range. And we've got a year end. You've got all sorts of factors, which might mean that banks need overnight finance to ensure that their books are square. And it's not just silver, for goodness sake. It could be everything. It could be interest rate swaps. I don't know, whatever, bond positions and so on. So, and also bond failures too. This is the other thing. Fails to deliver. Apparently, they've risen quite significantly. So, I think the point about increased margin requirements on futures and options, I think we must expect that with this volatility. It's not a bad thing. COMEX has to do it in order to protect itself because COMEX is standing there taking the counterparty risk for everyone. So it's got to manage this properly. It's not like an over-the-counter market like in London. The LBMA market is over-the-counter where it's principal to principal. So you've got counterparty risk is a big, big issue. It's not an issue for people trading on COMEX, unless, of course, there was widespread defaults and COMEX takes it on the chin and COMEX has to somehow fund it and all the rest of it. That is actually what the great taking is all about, how, COMEX will have available, if you like, all the collateral it needs in the form of ETF shares, in this case, which are owned by the DTC. So that is something which can be dealt with. So I think, we're going to see more and more margin increases, I think, until the volatility declines, if it does decline. So to my mind, it's not an issue. We should expect it. China is no longer suppressing the price of silver. It has given up doing that. It's been suppressing the price of silver for a long time. China is the second largest nation by mine output. Not only that, but she imports masses of silver doré and also other metallic ores, where silver, if you like, is refined out from that. So silver, in terms of global supply, silver is by far the largest entity when you take both mine output and also refinery output into account. From January, it's been announced by the Chinese authorities that they're tightening up on licensing for exports of silver. And what basically the principle behind it is to stop excessive amounts of silver going out of China. They're not stopping it totally, but it will be restricted. Now, this comes at a time when demand for silver is going off the charts. Not just photovoltaic cells, not just India, which incidentally has been subsidizing photovoltaic cell production at the government level. So Reliance Industries, for example, one of the very, very big conglomerates, they're building huge, great solar farms, and they're in the business of manufacturing this stuff big time. So they're going into the markets to get the silver, which they need for these photovoltaic cells. But the other thing which is driving it is electric vehicles, and the increase in range and so on and so forth comes really from greater use of silver in batteries. And Samsung have come up with a silver carbon battery, which gives you something like 900 miles, over 1,000 kilometers range. And it takes something like 10 to 15 minutes to charge. That's all. This is something which is being introduced, I understand, for the more expensive luxury vehicles, EVs, in 2026, and will be spread out from there. Now, the problem is that if you just have 20% of EVs having these Samsung batteries, then that's the equivalent of total mine supply of about 25,000 tons a year of silver. Because one of these batteries uses a kilogram of silver compared with, the sort of conventional lithium batteries taking about 4 or 5 grams. So the demand for silver is going up very, very substantially. The reason that we've got this problem is that suddenly everybody in the industry, if you like, needs silver. They've got to go and buy it. So they're actually raiding the markets. They're going into London and buying forward contracts and standing for delivery. They've been doing this on COMEX more visibly. Stand for deliveries this year so far are about 15,000 tons. So COMEX is, we don't know the number in London quite so much, but COMEX is the largest silver mine in the world, effectively. It's the largest source of silver. So, by a long chalk. I mean, if you're looking, I worked it out, something like 58% of mine production is actually being stood for delivery on COMEX. This is just staggering. So it's not surprising that the price for silver is going through the roof. I mean, the other point worth making is that we tend to look at these things as investors in regulated investments. Now, if the price of, let's say Microsoft or Nvidia or whatever goes up, then we know that it will rise to the point where sellers come in, because you've got buyers and sellers there the whole time. They're not all the same way. Okay, they like to ride a rising market, and more buyers will come in on the rising market. But at some stage, you will find that sellers will take profits, and so there will come in some supply. Price rises to the point where supply comes in. This is not happening with commodities, for the very simple reason that you don't have that depth, if you like, of investor interest. These are non-regulated investments. They're not in the investment pool at all. It's purely industrial. So any hedging there is from industrial sources. So if you look at mines, for example, traditionally they've been the ones that hedge production because, they've got the bills to pay and all the rest of it. And if they get a price for silver, they don't want to find that the silver which they extract over the next quarter buys less than it does today. So they would hedge their production. What do they do now? I mean, they've got no interest in doing that. It doesn't make any sense. They see what's happening. They know that China has stopped supplying the West. They know that prices are going higher. So what do? Mine? No, I'm not going to hedge I'm just going to ride it. I mean, why not? And not only that, But now we are actually profitable at these levels, and consequently we don't need to hedge future production. So this throws the emphasis back on the swaps, the bullion bank trading desks, in order to try and keep, if you like, keep the price down, or to take profits if they happen to be net long. They don't want to get into the situation where they're even more short, because basically they are short on COMEX. And the problem in London is they may well be long on London, but people are standing for delivery. And as they stand for delivery, they reduce the amount, if you like, of outstanding contracts, because someone standing for delivery, who has bought, in other words, let's say a bullion bank has sold, forward delivery of 1 million ounces or whatever, they will have covered themselves on the other side. So equally, someone who is long will find that, really, the market is contracting on him, and he can't cash it in. He won't find a buyer for his long position, because the entire market is contracting. The entire derivative market is contracting. So this lack of liquidity is really what's driving the whole situation. And I think that the fallout from the Chinese situation has only just started. It really has. It's an unusual event, but it does happen from time to time. And I think the other thing behind it is that, decades of fiat currencies have distorted the entire commodity scene so much. It's had the effect of driving commodity prices down in real terms, while they appear to be rising in dollar terms. It's because the dollar is not rising fast enough. The dollar price isn't rising fast enough to account for the depreciation of the dollar. Consequently, if you look at copper in particular, which is another must-have metal for the same reasons as silver, the price measured in gold is roughly 18% of where it should be in terms of long-term value. So that means that even priced in gold, copper is likely to increase by 4 or 5 times. So what does that do to the price of copper in dollars? Well, through the roof. And as the markets begin to understand this, the supply of copper is going to into markets is going to diminish. We've already got a battle royal between America and China over the Democratic Republic of Congo, and also in Zambia, which is the major copper producing center in Africa. So, and China, I understand, is the largest refiner of copper. If China puts that on the restricted list, then I think it's going to be, people will wake up, I tell you, they really will wake up.